Mastering the psychology of investing is an important key component of becoming a successful investor. In this video, we will take a look at a couple or a few psychological traits that investors who are aiming to become successful stocks investors should consider and should master as they are weathering their time in the stock market. Now, if you would like to learn more about all this stuff, please welcome back to Chibind Brothers. My name is Joel. Please allow me to ask you to hit the like button, subscribe, and turn on the notification bell as it helps us with the YouTube algorithm to get our message to a wider audience. So the first thing here is you have to be able to ask yourself the question of why are you investing in the first place? And most people don't know why they are investing, or most people are investing with unrealistic expectation. So the key component here is, are you wanting to invest and do you have realistic expectation or do you have unrealistic expectations? And what I should tell you in this video is everyone who's investing in the stock market should have realistic expectation. And what I mean by realistic expectation is this. For example, let's say you're starting with $1,000. So if you're starting with $1,000, you should be aiming, for example, to get maybe a 50% return on that $1,000. A 50% return on that $1,000, that means will have you growing that money from $1,000 to $1,500. That means making an additional $500. But most people have unrealistic expectation. They think that they can just come into the stock market with $1,000 and then they will end up a millionaire the next day. That's not gonna happen. I'm sorry, it's not gonna happen. That's not how it works. This is a very hard business that requires a lot of time, requires a lot of discipline, and requires people to be able to consistently grow their accounts, consistently grow their money in order to be able to multiply their starting amount of money that they had, for in this case going from $1,000 maybe to $10,000. That is 10x. But to be able to do that, you need to be able to have realistic expectations, and you need to follow those realistic expectations. So the second thing here is, what is your stock picking strategy? Guys, here's the thing. A lot of people invest into the stock market using emotions instead of being rational. You need to be rational about your investing strategy. And what I mean by being emotional while investing versus being rational is this. For example, you have some people who invest in stocks just because they like the stock. That is emotion. Okay, you're not supposed to invest in a stock just because you like the stock. Okay, here's the thing. You might be lucky when you invest in that stock just because you like it. You might be lucky to actually make money, but that doesn't mean that that should be your strategy. Or for example, because they saw a stock massively going up, now they think that it's time for them to go and buy that stock. These are all emotions. Or hearing someone else talking about a stock and believing, and that person saying that, oh no, this stock is gonna go to the moon. So then their emotion makes them realize that they're going to miss out, fear of missing out. So they go out and they buy that stock. No, you have to buy with rational. That means you have to be able to do your due diligence. That means you have to look at a stock critically. And at that stock, you have to look at, for example, why am I buying this stock? Does this stock has a competitive edge comparing to the other stocks in the same industry? What are the type of revenue that the stock of that company is generating? Right? So these are the things that people should be looking at, and all these different trends to be able to determine if the stock is undervalued enough and if it's great value for them to buy it, right? So this is rational versus the emotional parts that I just spoke about. So then the next thing that we're going to talk about is when it's time to buy stocks. Guys, you need to be able to have a strategy of when to buy stocks so that you can control your psychology and control your emotions. Here's the biggest mistake that a lot of people make. A lot of people go out to buy stocks because they saw it going up. Like I just said earlier, they go and they buy stocks. No, technically, I personally don't buy stocks on green days. No, my strategy is to buy stocks on red days. Why do I mean red days? These are the days that are bloody, where if you open your stock trading account and you just feel like you want to cry, okay? and I'm not gonna sit here and try to act like, that's never happened to me. It happens to all of us. That's what I'm trying to say. It happens to all of us. But the problem is you have to be able to manage your emotions, to be able to realize that usually it's when the stocks are going down. Usually it's when it's bloody on the streets that you're supposed to go in and buy, and not buying on green days, right? So that means you have to basically kind of apply a reverse psychology to be able to basically overcome your emotions of feeling bad because you're losing money to go in and buy the stocks on these red days. And the next thing is when to sell a stock. And guys, here's the thing. Before you buy a stock, you have to know when you're going to sell it. And this is the biggest mistake that a lot of people make, is they just go into a stock thinking that, hey, it's gonna go to the moon. But where is the moon? You're buying the stock at $50. What's the moon? 60? 70? $80? $90? You gotta know what the moon is for you, okay? So that means before you buy a stock, let's say you're buying a stock that is priced at $50, you have to have a target price in your head. That, hey, if this stock gets to $60 or if this stock gets to $70, I'm selling. Because if you just say, I bought the stock and I'm gonna sell it to the moon, what is the freaking moon? So you have to be able to have these realistic expectations and these strategies to be able to get into investing in the stock market. And guys, the last thing here is, how are you going to manage your emotions? Guys, because I have to be honest with you guys. It's not easy investing. There are times when you look at your account and it's just bloody red. It's bad. So then you have to be able on these days, here are my strategies that I usually do. If I wake up on a day and I open my stock trading account or investing account and, I just can't take the red, guess what I do? I close everything and I go out and do other stuff. I go out and focus on doing some other things. Sometimes you need to be able to walk away so that you can let your emotions calm down, so you can look at your investing strategy much more critically, using critical thinking, than making irrational decisions that are basically triggered by emotions, right? And this is the biggest mistake that a lot of people make. You're not supposed to do that. So guys, managing your emotions means sometimes not even looking at your stock portfolio. Just close it out for a couple of days and just chill out. Just do other things, focus on other stuff, and then you can go back to figuring out, okay, what went wrong? What can you do to tweak some things around so you can maybe make it go into the direction that you want it to go? And sometimes you don't even need to go in there and change something. Sometimes you just need to let it sit. Just let it be as it is, because the reason why you will just let it be is because you, in the time that you decided to just, chill, you maybe went back to reading some of the research that you had done in the past that actually made you take the decision of buying these stocks in the first place, which is what I do. I usually go back and ask myself, why did I even buy it? And that's what gives me the confidence of staying into that stock or even adding more to that stock. So guys, I hope that I provided you with enough value in this video. If that was the case, please allow me to ask you to hit the like button, subscribe, and turn on the notification bell, as it helps us with the YouTube algorithm to get our message to a wider audience. With that being said, if you would like to start investing into the stock market and don't have an account with Webull, please, you can sign up with our Webull link in the description below. And when you sign up and deposit at least $100, we both get free stocks. Or you can go with a passive investing route and sign up with our M1 Finance link in the description below. And when you sign up and deposit at least $100, we both get $30. And Conversely, if you would like to start investing into the cryptocurrency market and don't have an account with Coinbase, you can sign up with a Coinbase link in the description below, and when you sign up and buy at least $100 worth of crypto, we both get $10 worth of Bitcoin. And finally, if you would like to store your cryptocurrency on BlockFi and BlockFi will pay you interest on your money, please, you can sign up for a BlockFi account using our link in the description below. And when you sign up and deposit your cryptocurrencies on there, we both get some monetary value. With that being said, I'd like to say thank you, and I'll see you in my next video on Sunday. Bye.